Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com. Hi, today we're going to be talking about claiming losses from real estate. A lot of people have real estate that they rent, and I hear a lot on the internet and I see a lot on various social media about the importance of claiming losses in connection with real estate properties that are being used for rental purposes. The purpose of this discussion is to kind of clarify how losses can be utilized from the rental of real property. So when anybody has real estate that they are utilizing for rental income, we all know that there's a number of deductions that can be used to offset rental income. The first and probably the largest deduction is going to be depreciation. Anytime you are renting a home, a condo, any kind of real estate, you're going to be able to depreciate that property against rental income. It's not an option. You have to do it. It's in the Internal Revenue Code. It discusses how different types of real property is rented. There's a different depreciation schedule. If the rental property is here in the United States, there's a different depreciation schedule if the property is outside the United States. But you have to do it. It's not something that is optional. You have to depreciate the property. The depreciation itself is used against the income that you receive from renting the property. There's also a number of costs that are associated with renting property. There is some cases utilities. Other cases it's HOA. Other cases it's things like trash. The list goes on. But typically what winds up happening when someone rents property out at the end of the year, the expenses are going to be greater than the rental income that's received. And this is one of the reasons is that, say, for example, there's a large amount of depreciation that is given when someone rents property. So the question then becomes, which a lot of people have questions about, is, well, when you have all these losses that are associated with renting a property, what do you do with those losses? And can you go ahead and take those losses against other income, such as wages or salary or investments and other activities? So here's the way it works. All right. As a general rule, if you are having losses from real estate, what happens is that loss itself cannot be used against other incomes such as wages and salaries. Those losses typically are locked up and carried forward. And the day that you wind up selling that property, you use those losses to offset the taxable gain from the property. So the property itself over the years goes up in value. You also have depreciation recapture and so forth. And the losses that you don't use when you rented a property, that those losses at that point in time when you dispose of that property, that's typically what ends up happening. Now, what a lot of people consider is the concept of being classified as a real estate professional. And when I say real estate professional, I don't mean a licensed real estate agent. It's not a real estate professional. What I mean by a real estate professional is that this is an individual who is actively involved in the trade or business of renting real estate. So let's just say someone has 5 real properties, and the real properties are located all throughout the United States. And that individual is actively involved in operating those properties. Let's just say the tenant has an issue with the toilet. That person would take the phone call and if there's a problem with the property, such as a leaky toilet or a leaky sink, that person who owns the property, if they would take care of it themselves, that's kind of like how someone be in the trade or business of being a real estate professional or renting real estate, meaning that they do all the work associated with the rental of that property. They don't have a property manager. They're actively involved in operating that business of renting of the properties that are at issue. Now, it's not that simple. It's not just that you are, if you want to be a real estate professional, that you're actively involved in the renting of the property. You have to do this more than 750 hours a year. if you're in the trade or business of renting your property out and you spend more than 750 hours a year doing it, and you do it more than anything else, meaning that you do it more than your day job, then you're on your way to being a real estate professional for tax purposes. And in addition, you have to materially participate in the trade or business of renting the property, meaning that you're making the decisions of the property. If there's a problem in a property, you are materially participating, and you have to at least spend 100 hours a year of material participation in those properties. If you have more than one property, then you can make an election on your tax returns to group all the properties together. If you don't make that election to group the properties together, then you have to basically go ahead and satisfy that 750-hour rule plus material participation per property. So if you're trying to be a real estate professional, then you have to basically go ahead, make an election on your tax returns to group your properties together, and you have to spend at least more than 750 hours a year doing it, at least 100 hours a year of material participation in the trade or business of renting the properties, and you have to do it more than anything else, including your day job. If you satisfy these rules, then what you can do is the losses that you get associated with the rental of your property, at that point in time, you could take that against other income, such as salaries and wages. So if you are classified as a real estate professional, and at the end of the year, after you take into consideration your depreciation, your expenses associated with running your rental properties, whatever that amount is at the end of the year, rather than carrying that forward to the day that you go ahead and sell your properties, that amount, you can go ahead and utilize it against other source of income. Now, when does this wind up happening? This typically winds up happening when you have one spouse who is doing something, or some type of professional, or they're working a regular job, and the other spouse is acting as that real estate professional. Now, I spent a lot of time litigating tax cases before the United States Tax Court, the District Court, and the Court of Claims. And I could tell you that this is one of the areas that is the most highly litigated area. The IRS picks on these types of classifications. So if you're going to go ahead and claim that you are a real estate professional or a spouse of a real estate professional, it is extraordinarily important to keep good records. Keep records that establishes at least 750 hours a year in the trade or business of renting real estate. You can also establish at least 100 hours of material participation in renting the real properties. So participation, once again, would be like, showing up on your properties, handling any kind of tenant complaints, fixing things on a property, attending homeowner associations meetings. Those type of activities would be examples of material participation. Keep a detailed log of what you're doing. And should the IRS audit your tax returns, you should have those records available to the IRS to make sure that you could substantiate your material participation and then substantiate the fact that you're a real estate professional. Remember, the fact that you may have a license to be a realtor, that has absolutely nothing to do with the fact of whether or not you could satisfy this test and you can actually go ahead and claim your losses that you suffered in your real property against other sources of income. So keep good records of it. If you have more than one property, make sure that you're making an election on your tax returns to aggregate the properties into one. And the final thought of this, if you have an Airbnb property, there are special rules to the Airbnb property, and you may wind up satisfying all the rules that I just discussed, and you still may not be able to be classified as a real estate professional if you have Airbnb properties, short-term rentals. I hope that you found this discussion to be helpful. As always, this discussion itself is not meant to be an invitation to establish an attorney-client relationship. And this is also not meant to be legal advice. If you have any questions regarding what I just spoke about today on this video, please feel free to contact me directly.